Hey everyone, and welcome back to the channel where we demystify the complex world of finance. Today, we're diving deep into a specific stock that's showing up on our hard-to-borrow screener, a situation that often piques the interest of traders looking for potential short squeeze opportunities. But before we get into the details of ZCMD, let's get this out of the way. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, with that said, let's talk about ZCMD. ZCMD is a microcap company. Its specific sector isn't publicly available, but what has brought it to our attention isn't its industry, but rather its extremely high cost to borrow for short sellers. Now, before we explore why this is happening, let's quickly look at some recent trading activity for ZCMD. Chart or data overlay today's change exactly plus 0.0%. Over the last 5 days, also plus 0.0%. And looking back over the last 30 days, you guessed it, plus 0.0%. When it comes to volume, it's equally telling. Today's volume 0 shares. The 30-day average volume 0 shares. Which means its relative volume is also 0x average. This lack of any trading activity is a critical piece of information we'll revisit. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB, and why is it so important when we talk about short squeezes? Simply put, CTB is the annualized fee that a short seller has to pay to borrow shares of a stock before selling them. When you short a stock, you're essentially betting that its price will go down. To do that, you first borrow shares, sell them, and then, hopefully, buy them back later at a lower price to return to the lender, profiting from the difference. This borrowing isn't free. The CTB rate is determined by the supply and demand for those shares available to borrow. If a lot of people want to short a stock, and there aren't many shares available to lend, the CTB rate skyrockets. When these fees start to climb, sometimes even exceeding hundreds of % annualized, it puts immense pressure on short sellers. They're constantly bleeding money just to maintain their short position, which can eventually force them to reconsider their bet. Why this stock is hard to borrow right now. Now let's bring it back to ZCMD. This stock is on our radar because its cost to borrow fee is an astonishing 846.6% annualized. Emphasize number, that's one of the highest numbers you'll see. This indicates extremely high demand to short ZCMD, or an extremely low supply of shares available to borrow, or both. Our estimated float for ZCMD is a tiny 1.1 million shares. A small float means fewer shares are available for public trading, which naturally makes it harder to borrow shares for shorting. While we don't have exact numbers for shares currently available to borrow, that 846.6% CTB tells us it's extremely constrained. Our internal composite squeeze score for ZCMD, which factors in CTB, float size, and other dynamics, currently sits at 42.5 out of 100. This score suggests that while fundamental borrower dynamics are strong, other factors, like that zero volume, are limiting its immediate squeeze potential. The score reflects the underlying tension in the borrow market for ZCMD, even if it's not currently translating into market movement. The crucial point here, however, is that despite these compelling CTB numbers, ZCMD's current trading activity shows absolutely zero volume and zero price movement. This indicates extreme illiquidity, meaning there's no active buying or selling taking place right now. Squeeze mechanics explained. So, how does a high CTB relate to a short squeeze? A short squeeze happens when the price of a heavily shorted stock starts to rise. This rising price forces short sellers, who are now losing money and paying those high CTB fees, to buy back shares to cover their positions and limit their losses. This forced buying creates even more upward pressure on the stock price, which in turn forces more short sellers to cover, creating a snowball effect. That's the squeeze. A high CTB acts like a ticking time bomb for short sellers. The longer they stay short, the more expensive it gets, increasing the pressure to cover. However, it's vital to understand that a high cost to borrow does not guarantee a short squeeze. It can also simply mean that short sellers have incredibly strong conviction that the stock price is going much lower, and they are willing to pay those steep fees to stay in their positions. Dilution risk check. Another crucial factor to consider when looking at potential short squeezes is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of outstanding shares and can reduce the value of existing shares. For short squeeze, dilution can be a significant headwind because it introduces new supply into the market, making it easier for short sellers to cover or for new short positions to be established. It essentially gives short sellers an out or dampens any upward momentum. In ZCMD's case, we've checked for recent dilutive SEC filings like SMINUS1, SMINUS3s, or 424BS, and we found no recent dilutive filings in the last 90 days. We also found no recent reverse splits for ZCMD in our look-back window. This means that, from a filing perspective, ZCMD hasn't actively added new shares that could dilute existing shareholders or provide an easy supply for short sellers to cover. Just a friendly reminder before we continue, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given ZCMD's unique situation with its incredibly high CTB and small float combined with zero recent trading volume, what should you watch for? The absolute first thing to observe is any return of liquidity. For a stock with zero volume, a short squeeze cannot occur without active trading. You'd want to see consistent volume appear, indicating actual buying and selling interest. If volume does pick up, then continue to monitor the CTB fee for ZCMD. Look for it to remain elevated or even increase, which would signal sustained pressure on short sellers. Also, keep an eye on the supply of shares available to borrow. A shrinking supply can be another strong indicator. Finally, look for any news or catalysts specific to ZCMD that could suddenly ignite investor interest and bring that much-needed volume back into the stock. ZCMD presents a fascinating case study in the hard-to-borrow world. With an eye-watering 846.6% cost to borrow and a tiny 1.1 million share float, the underlying mechanics suggest significant pressure on short sellers. However, the current complete lack of trading volume is a critical factor that cannot be ignored. While high CTB is a key ingredient, it doesn't guarantee a squeeze, especially when there's no liquidity. For any short squeeze thesis to truly take hold in ZCMD, we would need to see a dramatic shift in trading activity. What are your thoughts on ZCMD? Let us know in the comments below. If you found this explanation helpful, please hit that like button, subscribe for more in-depth analyses, and share this video with anyone looking to understand these complex market dynamics. Thanks for watching, and we'll see you in the next one.